Deep Dive with David Stendhal, where we trade without ego, no emotion, no greed, and no opinion. Before we begin tonight's video blog, please read over our trading disclaimer and remember to trade smart and accept the reality that trading futures is risky. This presentation does not provide buy-sell recommendations, and our information is strictly provided for educational purposes only. As always, trade at your own risk and analysis. Hey, it's David Stendhal with tonight's Deep Dive. It is December 13th, 2017, and tonight's highlighted market's going to be sugar, the ETF being CANE, C-A-N-E. It's an ETF that is from the long side, and you'll see why that's important here in a second. Right now, with the market interpretation, we're looking at short, intermediate, and long-term all pointed to the downside as far as the trends. No surprise if you've been looking at sugar just recently. The technicals are still on the negative side. We don't have anything here just recently, at least today, that is pointing at some type of a bottoming to the market, but we are working on a secondary page that's all related to patterns, and we have a slew of things that will give us an indication as to what's actually taking place. Let's take a look first at what's going on with sugar, and you'll get a better feel, even though it wasn't really popping up in the deep dive just recently. So here's a daily bar basis here for sugar. The market has been trending down to the downside, and here is a support level with a 27, which quite honestly is quite strong. It's going back to the lows that were set over here. We have other support right through here, and then still further even more support over here. So we have kind of a stair-step effect. So I'm not necessarily saying that we're at the lows right now, even though one of our patterns just triggered today, but we are certainly at a point where there's a tremendous amount of support to the market at various levels. That's the major point here. So what did take place today, and the reason I'm highlighting this, is that you can see here with the energy level that the thrust to the market to the downside has been relatively strong. This coinciding with the fact that the market is oversold, not extremely unless it was red, but the yellow range where the market has been oversold, you get that combination of thrust to the market to the downside. No surprise that you have something that would be oversold, but you've also had oversold now for a few days, and that typically is a point where what we call that is a bottom, a pop to the market, a pop bottom. That's the term that we use to describe this type of a condition. And then just recently, back on the 11th, a couple of days ago, we had an elastic level pivot to the downside. So there's a couple things that are sort of foreshadowing the fact that the market is a little oversold, and that the shorts, which we are short the market, should be paying close attention to the market. So let's get right to the website, and we'll take a look at a couple things. First thing is the seasonal tendencies to the market. This being the 5 years, you can see that the trend has been to the downside typically in around this period of time, and now we're in that vicinity. It's not there yet, but the vicinity where the market typically bases and starts to rally at least a little bit. So the crescendo effect, which is what the pop bottom, that pattern I was just describing, is obviously foreshadowing. So if we have on the 5 years, we have the 10 years where it has already bottomed, and we'd be looking for a rally. And if we take a look at just the 5 and the 15, 5, 10, and 15, you can see that they're all starting to point to the upside, at least on the 5 and on the 10 and the 15, and the 5 is getting there. So no matter how you view this, you should be taking a closer look at your shorts and looking for an opportunity to unwind those shorts should the market warrant it. I'm going to take a look at seasonal depth, something I don't talk about all that frequently. You can see that sugar, if I can find it here's sugar, 7.76. What this represents is that if you look at the 5, the 10, the 15, and the 20-year correlations over an extended period of time, are they in fact something that follows seasonal tendencies on a regular basis? Lean hogs and S&P and certain other markets, RBOB, cattle, soybeans, those are all markets that you really want to be watching the seasonal tendencies. Sugar is still in the upper echelon, I'll say, but it's not necessarily the strongest, but it's definitely above average, and something that, given the fact that sugar on the 5 years, but specifically in the 10 to 15 years, a starting point higher, that it's something that you really should be paying, honestly, close attention to. Here is where we stand with the systems. Last I updated this, and so 3 o'clock. What we're looking at is we've got 4 systems that are short. We've got 60 minute, a 45 minute, 120, and a 45. And what that represents to us is that they're all short-term systems. They're short the market, and they will trigger here, fairly soon if the market does do any type of a rally. The other thing I want to point out is a chart that maybe some of you don't look at, but you should be looking at, and this is the breakdown. Is the position leverage for all of the markets that we trade, and I want you to think of this as like an RPMs. You're driving the car, you're looking at the RPMs, and you're looking at a market that is redlining, that is straining. And when you have a condition where the market is above 100%, as sugar is down right through here, it's basically 1 1/3, over 100%. What's basically happening here is that we have a number of systems, more systems than usual, that are short the market. And again, this kind of weaves into the crescendo effect that we're having here. We've got the pop bottom. We've got support to the market. We have a number of conditions where the market itself is probably a little ahead of itself, and sugar is one of these types of markets that can move to extremes. So look for our systems to start covering those shorts. Other markets that are overvalued, meaning that they're highly leveraged, we've got the 30-year bonds. We've got, in this case, copper. We've got crude oil, which is at 100%, but sugar is one of the 3 markets. Sugar, we've got 30-year bonds, and we've got copper, are the markets that are a little highly leveraged, more so than we would normally see. Now, I mentioned the support to the market. You can see that we have a couple conditions here. The support to the market right here is 1376. If we come back to this one, it's 1361. We come back still further, 1343. You can see 3 separate support levels to the market, and if we should break that, then we're going to have probably a bad condition where the market's really going to truly thrust to the downside. So what I want to show you is this. We have a number of support levels to the market. There is a condition here. Let me just go back here. A support gap, that there's a gap in the support. And what we have is sugar has a 3% gap to it. But the situation is that when you look at this condition, where is the gap? Where does it start and where does it end? So the best way to do that is to pull up the chart for sugar, and you can see that here is the gap. It's below 13.42, and then down to 13. So 13.5 down to 13, basically. So we have a number of support levels to the market that should theoretically hold the market. Hence the reason I've got concern over the short positions. But as soon as, or should we get down to this 1342 level, 1342.7 to be precise, if we should break it, then there's no more support to the market, and we're going to have this major gap. So we're at basically at a critical level. When we take a look at sugar in itself, we've got support to the market with as these different levels I just pointed out. We recently had an elastic level kind of pointing at that the market is getting into and beginning to become a little oversold. I mentioned the pop bottom that just triggered here today. We have obviously a combination here with the market being oversold, that there's enough that tells me that we're probably going to find some support here, but the caveat being that sometimes with a pop bottom, this condition that I've been referring to, the vast majority of the time, the market does base and starts to rally. That's what happens the vast majority of the time. But sometimes there can be an additional thrust, and if we should have that and should find ourselves in a position that we are below or approaching this 1342 level, that if for some reason we should break that there's going to be a major, well, there's nothing to hold it, and we would find ourselves back down at 13, which would be great for our shorts and the systems. But the reason I'm doing tonight's deep dive specifically on sugar is to forewarn you that the market could start to base here. Watch these markets, or this market, very closely. Watch these systems, and they could be liquidating themselves fairly quickly. This assuming that we don't get this this breakage of that support level. So that's reason that I want you to take a look at sugar as a whole, and we'll take a look at some more markets in time. I'll have another chart similar to what we have like here on the deep dive, and this one will be devoted to patterns, and we're working on that information right now. So we'll have more conditions that we'll be looking at that will pinpoint opportunities to either unwind short positions, as I'm describing here with sugar, as well as some other opportunities to actually go long specific markets at different times. So it doesn't just have to be systems. You can have and use these types of tools, these patterns, and in a discretionary standpoint as well. So we will take a look at some more markets tomorrow, and thanks for watching. Bye-bye.